If your entire investing plan rests on the assumption that the price of a stock, or any asset, will rise in the future so you can sell it for a profit, you don't have a strategy. You have a wish, dressed up as a plan. Real investing isn't about crossing your fingers and hoping someone will pay more for what you bought. It's about analyzing value, understanding risk, and positioning yourself so that your money works for you regardless of what the market decides to do tomorrow. Relying solely on the hope that prices will go up is a gamble, plain and simple. It's emotional, reactive, and entirely outside your control. Hope does not generate cash flow. Hope does not cover expenses. Hope does not compound returns. Hope is a prayer in disguise, and in the real world, prayers don't pay the electric bill, mortgage, or tuition. A proper strategy involves having clear objectives, defining how and why an investment will make money, and building resilience for when markets inevitably turn against you. It's about owning assets that produce value, not betting on the optimism of strangers. If your plan evaporates the moment someone refuses to pay a higher price for what you hold, you aren't an investor, you're a speculator, and speculators don't build wealth, they hope for it, and hope is not a business model. Most people grow up with a single story about investing, and that story never really changes. You work, you save, you put money into the market, and one day far in the future, if everything goes right, you're allowed to live off it. Income is framed as the finish line, something reserved for retirement, something you unlock only after decades of patience. Until then, you're told to focus on growth and ignore cash flow completely. That story sounds reasonable, but it quietly sabotages almost everyone who follows it. Because when income is treated as a reward instead of a tool, people spend the most valuable years of their investing life waiting for compounding to kick in, waiting for the portfolio to get big enough, waiting for the numbers to finally matter. And for many investors, especially those who start later or earn average incomes, that moment never arrives in any meaningful way. What rarely gets discussed is that income does not have to come at the end. Income can be built early, deliberately, and used to accelerate the entire process. But doing that requires abandoning some deeply ingrained assumptions about how investing is supposed to work. One of those assumptions is that income must come from dividends, and that dividends must come from large, slow-moving companies. That belief alone has kept entire asset classes off the radar for income-focused investors. Small-cap stocks are a perfect example. For decades, small-cap companies were treated as speculative growth plays, too volatile, too risky, too unpredictable. They didn't pay meaningful dividends, so income investors ignored them completely. Growth investors, on the other hand, loved them when conditions were right, especially during periods of economic expansion and easy credit. What almost no one bothered to explore was whether small caps could be transformed into income-producing assets without relying on dividends at all. The irony is that small caps possess exactly the trait income strategies need most: volatility. Volatility is the thing retail investors are trained to fear. It's framed as danger, instability, and risk. And, when unmanaged, that's exactly what it is. But in financial markets, volatility is not just chaos. It's also a commodity. It has a price, and that price shows up in the options market. Options exist because investors want leverage, protection, and speculation. Every time someone buys an option, someone else sells it. The seller collects a premium in exchange for taking on defined risk. That premium is cash, paid immediately regardless of what the market does next. When volatility is high, those premiums rise. When volatility is low, they fall. Either way, as long as markets move, options retain value. This is where the entire income conversation shifts. Instead of asking, which companies will pay me the highest dividend, the question becomes, which assets consistently generate option premiums without relying on a single company's survival? Small cap indexes answer that question better than most people realize. They represent thousands of companies across industries. No single earnings report can destroy the entire index. No single management team can make a catastrophic decision that wipes out income overnight. And because small caps move more aggressively than large caps, the option premiums attached to them are structurally higher. That combination is not accidental, it's mathematical. Historically, whenever interest rates fall or liquidity increases, small-cap stocks tend to outperform. This happened after the early 2000s recession. It happened again after the 2008 financial crisis. In both cases, small caps rebounded faster and harder than large caps once credit conditions loosened. But even during periods when price growth stalled, volatility often remained elevated, and volatility, when harvested correctly, produces income even in sideways markets. This is the piece most traditional dividend investors never internalize. Dividends depend on corporate decisions. They can be cut, paused, or eliminated entirely during recessions. Income that depends on volatility depends on market behavior instead, and markets do not need to be healthy to move. In fact, they often move the most when conditions are uncertain. That distinction matters more than people want to admit. During the financial crisis, dividend investors watched payouts disappear across entire sectors. Banks, industrials, and consumer companies all slashed distributions to survive. Meanwhile, volatility exploded. Options premiums surged. Strategies designed to sell volatility didn't rely on optimism or growth. They relied on fear, uncertainty, and constant price movement. This isn't a hypothetical advantage. It already happened. The reason most retail investors never benefited from it is simple. They were never taught to think of income as something that could be engineered. Instead, they were taught to chase yield. Yield chasing is one of the fastest ways to destroy a portfolio. High yields look attractive, especially to beginners. 7%, 8%, 10%. It feels like free money, but yields don't exist in a vacuum. They are signals. And extremely high yields are almost always warnings. They often indicate falling share prices, unsustainable payout ratios, or businesses under stress. When the dividend gets cut, the income disappears, and the capital loss remains. The investor loses twice. Options-based income, when structured correctly, avoids that trap by shifting the source of income away from corporate payouts and toward market mechanics. The income doesn't come from a company deciding to reward shareholders. It comes from other market participants paying for exposure, leverage, or protection. That doesn't make it risk-free, nothing is, but it changes the nature of the risk. Another reason this strategy has gained attention recently is psychological, not mathematical. Investors have lived through repeated shocks, market crashes, inflation spikes, interest rate whiplash, entire years of gains erased in months. People are tired of portfolios that look good on paper but feel useless in real life. They want cash flow. They want money hitting their account consistently. They want something tangible they can measure and rely on. This shift in mindset explains why income-focused exchange-traded funds have exploded in popularity over the past decade. Tools that were once reserved for professionals are now being packaged for everyday investors, but packaging alone doesn't make a strategy sound. The danger is treating income funds as magic solutions without understanding what they trade off. Covered call strategies, by design, limit upside. They exchange some future growth for present income. That trade-off must be intentional. Used blindly, it leads to disappointment. Used deliberately, it becomes powerful. This is where most people get it wrong. They compare income strategies to pure growth strategies and complain that income underperforms during bull markets. That's like complaining that a pickup truck doesn't handle like a sports car. It's the wrong comparison. The purpose of income is not to win performance charts. It's to shorten the distance between effort and reward. It's to reduce dependency on future assumptions. It's to bring compounding forward instead of backloading it into old age. When income is reinvested, it doesn't just sit there. It buys more exposure, more shares, more income-producing capacity. Over time, that feedback loop becomes its own growth engine. This is the core idea most investors never grasp because they're too busy arguing about which strategy is best. There is no single best strategy. There is only alignment between goals and tools. Someone chasing maximum upside with decades ahead of them may accept volatility and delayed income. Someone trying to build cash flow within a realistic time frame cannot afford to wait forever. The mistake is assuming everyone should follow the same path. This is why the conversation around income investing needs to evolve. It's not about abandoning growth. It's about redefining what growth actually means. Growth is not just account value. Growth is optionality. Growth is flexibility. Growth is the ability to make choices earlier instead of later. When income is treated as an engine instead of a destination, investing stops being a waiting game. It becomes a system, and that is the foundation everything else is built on. Most investors don't lose money because they picked the wrong asset. They lose money because they picked the right asset for the wrong reason and then behaved incorrectly when reality showed up. Income investing is where this flaw becomes impossible to hide. People approach income strategies carrying growth expectations like emotional baggage. They say they want stability, but they secretly crave acceleration. They say they want cash flow, but they still judge success by chart direction. That contradiction doesn't resolve itself. It explodes later, usually at the worst possible moment. Income products are not built to impress you. They are built to function. If you need excitement, validation, or social proof, income investing will feel broken even when it's working perfectly. The first mistake is thinking yield is a reward. Yield is a conversion mechanism. You are converting future uncertainty into present certainty. That conversion has a cost. Anyone who tells you otherwise is either lying or doesn't understand what they're holding. When a strategy produces double-digit income from assets that traditionally yield almost nothing, the money is not appearing out of thin air. It is coming from volatility, from foregone upside, from timing differences, and sometimes from your own capital being returned to you under a different label. None of that is inherently bad. What's bad is pretending it's free. This is where people panic over terms instead of understanding mechanics. Return of capital sounds scary because people imagine their investment being handed back to them piece by piece, like a melting ice cube. That's not how it works structurally, but fear doesn't care about accuracy. Return of capital is a tax classification, not a verdict on performance. It often exists because gains and losses are being netted efficiently inside the structure. It reduces cost basis, defers taxes, and shifts when the bill comes due. That can be incredibly powerful for the right investor and disastrous for someone who doesn't understand what they signed up for. The real risk is not return of capital. The real risk is thinking income equals profit. Income is cash flow. Profit is outcome. Confusing the two leads people to overspend distributions, ignore total return, and slowly hollow out their own portfolios while telling themselves, everything is fine, because money keeps arriving. That illusion can last years, long enough to do permanent damage. Another uncomfortable truth is that income strategies expose emotional weakness faster than growth strategies do. Growth investors can hide behind unrealized gains and narratives. Income investors face reality monthly. Cash shows up or it doesn't. That immediacy magnifies mistakes. This is why people who don't truly understand their risk tolerance should stay away from complex income products. Not because they're evil, but because they are honest. They don't cushion bad behavior, they amplify it. Volatility is another area where people lie to themselves. They say they can handle it until it actually happens. Small cap volatility, option volatility, macro volatility, interest rate volatility. These are not abstract concepts. They directly affect distributions, pricing, and sentiment. Volatility is not just price movement. It is emotional pressure. It is uncertainty about next month's payout. It is the temptation to intervene when a system is designed to be followed, not micromanaged. This is where rules-based strategies matter, not because humans are stupid, but because humans are inconsistent. A system that removes discretion during stress is not restrictive, it is protective. When markets sell off, income strategies often fall alongside them. This surprises people who thought income meant downside immunity. That belief alone tells you they didn't understand the product. Income offsets drawdowns. It does not eliminate them. What matters is what happens next. A disciplined income structure does not panic during sell-offs. It continues executing. It continues harvesting volatility. It continues resetting exposure. When markets recover, it participates within its defined limits. That's not luck. That's design. People who abandon income strategies during drawdowns are not reacting to losses. They are reacting to violated expectations. Expectations are everything. The same misunderstanding shows up during bull markets. When markets surge, income strategies lag. They are supposed to. That lag is the cost of the income already received. Complaining about that is like complaining that insurance didn't make you rich during a sunny year. This is why cycle awareness separates adults from amateurs. There are environments where income strategies shine, and environments where they look dull. Anyone promising dominance in all conditions is selling fantasy. Real portfolios are built for survivability, not bragging rights. Margin enters this conversation whether people like it or not, because income and leverage are a dangerous combination for undisciplined investors, and a powerful one for disciplined ones. Margin doesn't change the strategy, it magnifies the consequences. Using margin to enhance an already stable, diversified, well-understood income stream is very different from using margin to patch a lifestyle shortfall. One is a tool, the other is a dependency. Most people who talk about margin online shouldn't be allowed near it, not because they're unintelligent, but because they confuse confidence with competence. Margin punishes that confusion brutally. The same applies to early retirement fantasies. Income investing gets marketed as an escape hatch. Quit your job. Live off distributions. Never worry again. That framing is dangerous because it treats income as an endpoint instead of a resource. The most resilient use of income is not replacement, it is flexibility. Income that reduces pressure buys time and creates optionality compounds into something far more valuable than income that merely pays bills. The latter creates fragility, the former creates leverage. This is where frugality stops being about deprivation and starts being about power. Low fixed expenses widen margins of error. High fixed expenses shrink them. Income strategies amplify both outcomes. They do not rescue bad cost structures. People who say income investing is lazy are usually projecting. Proper income investing requires more self-awareness, not less. You must accept capped upside, tolerate relative underperformance, and resist constant optimization urges. Most people can't. That's why they bounce between strategies, chasing whatever narrative sounds safest or smartest at the moment, never staying long enough for anything to work as designed. The harsh reality is this: a portfolio is only as strong as the behavior of the person holding it. Income strategies remove excuses. They force alignment between goals, temperament, and action. If someone cannot explain why their portfolio might underperform for years and still be correct, they don't have a strategy. They have a story they tell themselves to feel better. Stories collapse under pressure. Strategies don't. Income investing is not about beating markets. It's about reducing dependence on prediction. It's about converting uncertainty into structure. It's about acknowledging that time, emotions, and life constraints matter as much as returns. That trade-off is not for everyone, and that's fine. What isn't fine is pretending there are no trade-offs. Income investing is not a shortcut to wealth. It is a system for control. Most people misunderstand it because they approach it with growth investor expectations, emotional baggage, and unrealistic assumptions about safety, yield, and effort. When those expectations collide with reality, investors don't fail because the strategy is broken. They fail because their behavior is.